Welcome back to the deep dive. Okay, today we're getting really targeted. We're skipping the prepared remarks from the Hims&Hers Q3 2025 earnings call. We're diving straight into the Q&A. That's where the real strategy gets revealed, right?
Absolutely. The Q&A forces management, the CEO Andrew Duham and CFO Yemi Okupe to really show their hand beyond the standard results. Our mission today is to pull out those key new growth plans they talked about: diagnostics, longevity, international expansion.
And crucially, how all these big moves actually impact the money side, the margins, how they're spending capital, especially looking out to 2026.
Exactly. We need to map that financial roadmap.
So we're basically listening in on the conversation between management and the analysts, the investors, figuring out what they think the big growth drivers are. It sounds like a shift from single problems to whole body health.
That's the narrative. Let's get into it.
Okay, first huge piece of news seems to be this push into proactive health. The CEO called it true equalization. They're launching comprehensive whole body lab testing like immediately, before year end.
Yeah, and the pricing is, well, it's aggressive. They mentioned these tests usually cost, what, $5,000 to $10,000?
Right, upwards of $5,000 to $10,000. And Hims&Hers says they'll offer it for an absolute fraction of that cost.
That's a game changer if they pull it off.
Yeah.
It's not just a new product line. It fundamentally shifts them from being reactive, treating hair loss after it happens, to being proactive.
So getting ahead of things.
Exactly. Getting data on nutrient levels, hormones, even genetic risk markers. Things you would normally know until there's a problem.
And the CEO pointed out that having this data, their own proprietary data, basically act like a turbocharger for developing new stuff.
It speeds everything up. They see a need in the data. They can quickly develop or adapt to personalized treatment. It makes the whole product pipeline faster, more targeted.
Okay, so testing leads to treatments. What's next?
Well, this testing directly sets up their next big specialty: longevity. That's planned for 2026. And when they say longevity, they're talking performance, recovery, cardiometabolic health. Think optimizing your body long-term.
What kind of treatments are we talking about there?
It's a pretty broad range mentioned. Things like on-market peptides, coenzymes, GLP treatments, and also GIP treatment.
Okay, hold on. GLP-1s, most people know those for weight loss now. What are GIP treatments?
Good question. So GLP-1 affects appetite, insulin. GIP is another hormone, gastric inhibitory polypeptide. It works in a complementary way. When you hear about dual or triagonist drugs, they're hitting multiple pathways like GLP-1 and GIP, often giving better results, maybe not just for weight, but for those longevity markers too.
Got it. And this ties into their whole vertical integration strategy, right? They mentioned that peptide manufacturing plant in California.
Exactly. Big strategic advantage. They're onshoring a lot of R&D, as they put it, for peptides like BPC 157 and TB 500.
Okay, for listeners maybe not deep in the health space, BPC 157, TB 500, what are those?
Right. These are more specialized research peptides. BPC 157 is often studied for things like gut health, tissue recovery. TB 500 is linked to cellular repair, faster recovery from injury. By bringing the R&D and manufacturing in-house, they control quality setting a gold standard, but also, crucially, cost. They can make these specialized things affordable.
Taking them out of that niche, small, affluent subset market, as they said?
That's the goal: democratization.
Okay, let's shift to the core business. Some retail investors actually asked about growth slowing down in the older parts of the business, like the longer tenured stuff.
Yeah, that came up.
Yeah.
The CFO seemed pretty confident, though. He projected that core growth would actually re-accelerate, but not until the second half of 2026.
Re-accelerate based on what, though? More hair loss pills?
No, not really. That confidence seems pinned entirely on these new specialties taking off. Diagnostics and longevity for Hims and things like menopause support for Hers. They're betting these new, more complex offerings will drive the next wave of growth, kind of making up for any slowdown elsewhere.
But is there a risk these new things cannibalize the old? Or is this just management saying, trust us, the big investments we're making now will pay off later?
It's definitely a calculated bet. Look at what they're doing in sexual health. They admitted there's a near-term headwind there.
Why?
Because they're deliberately shifting away from those on-demand single-use pills towards more personalized daily treatment plans.
Ah, okay. Trading quick sales for stickier customers.
Precisely. They'll take a hit on volume now because someone on a daily personalized plan sticks around much, much longer. They want that long-term revenue retention, aiming for 85% plus.
And they think that headwind goes away when?
They said it should meaningfully dissipate in the second half of next year. So mid to late 2026.
Okay, that structural change makes sense with the marketing shift they talked about too. Marketing
Hey.
for hair loss or ED is, well, it's sensitive, stigmatized.
Exactly. Historically, it was all direct marketing, focusing on privacy because people didn't want to broadcast those issues.
But diagnostics,
Mm-mm.
longevity, performance optimization, that's different.
Completely different. That's the really deep insight here, I think. Moving from marketing stigmatized conditions to marketing proactive health unlocks huge organic potential. The CEO literally said, these are things you want to share with the people you love.
So practically, what does that mean? Fewer awkward hair loss ads, more?
Yeah.
What? People sharing their health scores?
Kind of, yeah. If you're solving a secret problem, you pay a lot for direct ads. If you're offering a way to live longer or perform better, that fits into the whole wellness culture, like fitness. People talk about it, share results. It means they can potentially rely less on expensive paid advertising and more on word-of-mouth social sharing, organic channels.
Which long-term should lower their customer acquisition costs, their CAC.
Fundamentally lowered it across the whole platform. That's the strategic leverage they're aiming for.
All right, let's talk weight loss. Still sounds absolutely central to
Oh,
everything.
definitely. The CEO hammered home the strategy. Breadth and assortment and choice,
Mean,
meaning they want to offer everything. Compounded GLP-1s, yes, but also oral options, partnerships with the big pharma companies like Novo Nordisk for Wegovy injections, maybe the oral Wegovy pill eventually.
and those next-gen GLP-1s, the GIP ones we talked about.
Yep, dual and triagonist too. Maximum optionality for the patient, whatever's safest, most effective, most affordable for them.
And affordable seems key. The CFO mentioned their consistent strategy: scale up, verticalize, optimize, and pass savings to subscribers.
Right, which is why they just did that strategic reduction in prices for their compounded GLP-1s. Dropped them by up to 20%.
Which sounds great for users, but the CFO flagged a pretty big financial hit because of it, or related to it.
Yeah.
A $20 to $25 million drag in Q4.
Yeah, tied to a logistics and regulatory thing. It's complicated, this cadence issue.
Okay, break it down for us. Cadence issue.
It's quite technical. Basically, they're moving their sterile weight loss, compounding from what are called 503B facilities, think big industrial outsourcing pharmacies, to 503A facilities.
The 503A is.
Smaller state-licensed pharmacies doing custom compounding for individual patient prescriptions. The idea is more direct control, better quality assurance for personalized meds.
Okay, but why does moving facilities cause a $25 million hit to the P&L?
Because the rules for 503A often mean shorter shipping cycles. Instead of sending a 90-day supply every quarter, maybe you send a 30-day supply every month.
Right.
And since they recognize revenue when they ship the product, if you ship smaller amounts more often, you recognize less revenue per shipment initially.
Ah, okay. Like paying monthly versus quarterly. Less cash upfront each time, but the same total over the year.
Exactly. So it looks like a revenue dip in the short term, but it's temporary. The CFO explained that this revenue normalizes and starts stacking up again in the second half of 2026 as those monthly cohorts renew more often.
So the argument is it's an investment in quality control that just messes with revenue timing for a bit, not a sign of weak demand. Are analysts buying that? $25 million is still a chunk of change.
Management sounded very sure, and they immediately followed up by reaffirming their full-year 2025 weight loss target, $725 million or more.
Okay, sticking to the big number.
Yeah, the narrative is clear. Long-term quality over short-term accounting optics.
Let's switch focus a bit to the Hers segment. That part of the business seems to be on fire, right? Growth near or above triple digits.
Yeah, hers is performing extremely well, and they've set a really ambitious target for it. Over $1 billion in annual revenue in 2026.
Wow, $1 billion just for Hers. How did they get there?
It's not just one thing. They have multiple engines driving it. There's the legacy dermatology business, which is still strong. Then there's weight management, where they've seen good traction with oral and personalized options for women.
Yeah.
And then, crucially, the new hormonal health stuff, things like perimenopause and menopause support. It lets them reach women at different life stages, often with overlapping needs.
Okay, makes sense. And this model, affordability, access, personalization, it's clearly working domestically. Are they seeing that same demand internationally?
It seems so. The Zava acquisition looks like a success story. That gave them the infrastructure, the footprint, across the UK, Germany, France, Ireland, Spain, major European markets. Their core belief seems to be that frustration with traditional healthcare, the hassle, the cost, the waiting is pretty universal.
So where's the next big international push?
Near term, it's Canada.
Canada. Why Canada specifically now?
Timing. They're getting set up for the generic version of semaglutide, the weight loss drug, which is expected to launch in Canada in 2026. And Canada is a big market for this. Management pointed out that two-thirds of adults there are overweight or live with obesity. So huge potential once the cost comes down with generics.
Makes sense. And longer term, beyond North America and Europe.
The ambition is definitely global. They talked about deepening investment in the UK, but also looking at places like Brazil, Australia, other markets in Latin America and Asia.
Wow.
They think international could eventually be another billion-dollar-plus opportunity. The playbook seems consistent. Find markets with high demand, clunky healthcare systems, and bring in their consumer-focused, tech-enabled model.
Okay, but all this expansion, new buildings, going global, R&D for these fancy peptides that cost money, serious money.
Absolutely. And the CFO was upfront about it. He basically said, expect a temporary pause in year-over-year margin expansion, starting Q4 2025 and carrying through 2026.
So margins might flatten out for a bit.
Yeah, because they're making what they call meaningful investments, expanding their physical footprint to over 1 million square feet for facilities, hiring lots of technical talent.
Technical talent like engineers or clinicians.
Both, but also specifically for things like AI-assisted tools, nutritional coaches, those sophisticated chatbots they mentioned.
How does investing in, say, a chatbot help margins or growth in the long run? Seems counterintuitive.
It's all about scale and efficiency. Think about personalized care. The most expensive part is often the human interaction, the clinician time, the coaching. AI and chatbots can handle a lot of the routine stuff, initial questions, checking in on adherence, basic info. That frees up the human experts, doctors, nurses, coaches to focus only on the complex cases.
Ah, so one clinician can effectively manage more patients.
Exactly. It dramatically increases capacity and lowers the cost to serve each patient over time. It helps scale the personalized model without linearly scaling the expensive human cost.
Right, okay. And it helps that they have the cash to make these investments. The balance sheet looks strong, over $1.1 billion in cash and investment.
Very strong. And they're generating good cash, too. $149 million from operations in Q3, $79 million in free cash flow.
So how are they thinking about using that cash pile?
The framework they laid out has a couple of key areas. First, strategic M&A mergers and acquisitions, like that investment they made in Drail.
Okay, Drail does multi-cancer early detection tests. Why would Hims&Hers invest there? Seems a bit different.
That's a great question, and it actually ties back perfectly to the main theme. It reinforces the shift from just treating problems to proactive diagnostics. Investing in early cancer detection capability makes their whole platform more comprehensive in terms of proactive health insights. It strengthens the argument for their whole body testing.
Got it. So it fits the bigger picture. What's the second use of cash?
Share buybacks. But only, they stressed, when they see a meaningful disconnect between what they think the company's intrinsic value is and what the stock market price is. Basically buying back shares when they think the stock is undervalued.
Protecting shareholder value. So despite this temporary pause in margin growth, they're sticking to the long-term targets.
Absolutely reaffirming them. That 2030 goal of at least $6.5 billion in revenue and $1.3 billion in adjusted EBITDA. In fact, the CEO kind of implied these opportunities are showing up even faster than they first thought, which is why they're investing so aggressively right now.
Okay, so wrapping up this deep dive into the Q&A. The big picture is this huge transformation, right? Moving from just telehealth for specific issues to becoming this vertically integrated, proactive health platform.
That's the essence of it. They're building a system based on getting health insights from diagnostic data and turning that into personalized ongoing care.
Turning data into action.
Exactly. And the key differentiator, the thing you really need to grasp, is the business model behind it. Think about that LTV/CAC ratio, lifetime value versus customer acquisition cost. They don't see diagnostics as the place to make big margins on the test itself. They're not trying to charge you thousands for labs.
Right.
Instead, diagnostics are like a super affordable way to bring you into their system, a lead generation tool. Then, because they control the quality and cost of the personalized care that follows that test, they build a long-term relationship.
So cheap test gets you in the door, good personalized care keeps you subscribed and healthy, driving up lifetime value.
That's the model. High LTV relative to the initial pack. It makes the whole thing work financially.
Makes perfect sense when you put it that way. Get the customer cheaply, keep him healthy, and subscribed for the long haul.
Which leads to maybe a final thought for you, the listener, to chew on. If this model really works, if they can take things like longevity treatments, whole body diagnostics, stuff that used to be only for the super rich, and make it genuinely affordable and scalable, what's next? What other health condition or specialized treatment that seems like a luxury or niche market today could be the next frontier they try to democratize for everyone? Something to think about.